What is up, everybody? Logan here again. I hope you had a fantastic Christmas holiday with the family, and I hope you guys are having a great day today as well. I had to wear my Saints jersey today. Alvin Kamara with the 6 touchdowns. Just had to bring some light on that, so I think they're going to do well and continue to do well this year. But let's talk about how to execute put credit spreads and how to trade those and build your account that way on Robinhood. Now, this is one thing I've been wanting to do for a while, as Maz and I have that video on how to do it on Thinkorswim, but I know a lot of you guys use Robinhood that watch my videos. I use Robinhood to execute these still as well in one of my accounts, so why not show you guys how to execute put credit spreads on Robinhood so that you can take your trading to the next level. You can mess with your probabilities, because that's one thing, right? If you're playing single call options or single put options, you have a 30% chance of profit going into the play, but with credit spreads you can manipulate that to where you could have anywhere from 80% to 90 to 95, and of course you're giving up gains while you do that with the higher probability, but you can manipulate the amount of risk you want to take on, which I think is something that's really cool. Before we get into this video, if you guys could leave a like and subscribe on this video, it would mean a ton to me. Make sure you join the Discords below. We have the premium Discord, so for $30 a month you get all my call outs. Also, there's other traders in there as well. And then we also have the free Discord, which just passed 1,000 members. So I want to say thank you guys for all the continued support, the subscribers, just over 2,500 now. I'm so blessed and just so happy that we have this amazing community. So let's hop right into the first fund that this is my favorite fund to trade credit spreads on 100%. If you look at the last 3-month chart, if we go to November 9th, the lowest it's been since the 9th is 290.105. And it's been pretty consistently staying above that level all the way up until today. So this is one of my favorite funds to trade, and even if we look at the past year, it stayed pretty consistent, right? I would say with the amount of movement within the week, but even this past week with the $3 movement from open till close, I mean, that's just a 1% movement. Pretty safe to play credit spreads on a fund like this, right? Of course, unless you're buying spreads that are only $2 away from the strike price or so. This is one fund that I love to play put credit spreads on, just because of the consistency and with the VIX lowering like it has in the last couple of weeks. This is a fantastic fund to play on. So if we go to trade, I'll show you guys how to execute one on DIA. And if we go down, actually, you can see here this past week I had a 292 put and a 289 put. So I sold the 292, bought the 289, and I got credited the amount, and that was actually what you saw at the beginning of this video. So if we look over here, we'd go to December 31st. I play the weeklies. This is something that Maz taught me. So if we go to play the weeklies, right, we want to see how much movement that this fund had in the last week, which was a $3 movement on the Robinhood chart. Now, what I do is I look at where we closed on Friday and where we open on Monday to kind of pick that standard deviation movement. The market's closed right now, so these prices aren't going to update in real time because it's Saturday. So if we go to like a 294 put, you see that we have an 88.99% chance of profit that DIA isn't going to fall below 294. If we look here, you could even go to the 292 put. We'd hit select with a 92% chance of probability of profit. I think that's a really phenomenal spot to be in. So if we hit sell on the 292, we scroll down to the 289, we hit the buy select, you hit continue, and then put credit spread will come up, right? So to sell a 292 put and to buy a 289 put, you would receive 10 credit for putting up. So if I typed in 1, well, I guess 10, but now it's updated to 11. If I hit review, your minimum credit of 11 for putting up $300 in collateral. Now, this is what spreads do, is spreads allow you to protect yourself from just selling a naked put, because if you were to sell a naked put, if we go back here and I didn't have this buy option, if I uncheck that and I just wanted to sell a put, right? Guess what? I don't have enough buying power. Even though I have $11,000 in buying power, here's why. When you go to sell a put, selling 100 shares of DIA at a 292 strike price, which would require me to have $29,200 in buying power. If you want to avoid that, you can just buy a put below it against it and still get a really good credit, right? Without having to have 30 some, close to $30,000 in buying power. We're selling the 292 put, we're buying the 289, we go to review, we're gonna buy one contract. So our credit that we would receive by expiration, if we let this go to 100%, would be $11 for putting up 300 in collateral, right, with a 92.5% chance of winning, which is fantastic. Now, I look at this, and the first thing that I check is how much collateral. Okay, 300 collateral. And the reason you need 300 collateral is because the difference between 292 and 289 is $3, right? And in options, 3 times 100 is 300. So you sell the higher strike, you buy the lower strike price on a put credit spread. The next thing I look at is how many contracts am I getting. You can choose as many as you want. Just for this example, I would roll with 1. Then the next thing I look at is the limit price. Now this is 11, meaning that the credit we would get for putting up $300 is 11. So the next thing I do is I go to my calculator, and on the calculator I do 11 divided by 300 to get my percent, which after you move the decimal place over comes out to 3.66% on this put credit spread. So then I take into consideration, with a 92.5% chance of winning, is it worth putting up $300 to make $11? Now, in my opinion, yes, that is worth it. Which then brings us to our next question, right? Which, when is it not worth putting up that amount of collateral to make a specific amount of credit? And in my personal opinion, anything under 3% is not worth my risk, right? If you put up $1,000 in collateral to make $20, I feel like there's better ways to do that than putting up 1,000 to make 20. I feel like you could do that by putting up maybe 600 and looking for 20, right, in a week. That's just my personal opinion, and we can look at that right now. Let's say, you wanted a higher percent chance, so you went to sell put. We look down here, all right, let's say we have the 287. So we'll sell that one, and then we'll buy the 285. So you're putting up 200 to make $2. Now if we go and do that, right, I mean, you could buy 20 contracts. We do a credit spread. If you look right here, you'd put up $4,000 to make $40, and that's saying that DIA won't fall below 287. DIA is currently 301. I don't see that happening, so your probabilities are insanely high. And if we do go back, if you were to sell the 287, it looks like you have about a 96.8% chance of winning as of right now, which is fantastic. But in my personal opinion, that's just 1%. I don't think I would put up $4,000 to make 40. I think you could make more with that by having a little bit more risk, but still a high chance of profit, right? Even though you're super safe down there, of course, if a flash crash were to happen or anything like that, I think you would kind of think, like, let's say it dug into your collateral and you're sitting there like, wow, I took a loss, whatever that loss is, because I was trying to make $40 with $4,000. Now that's really good. If you have a lot of money, yeah, that would be fantastic, but I still think for someone who's trying to maximize their percent gains and really build their portfolio without having to continually add money over and over from their bank account, I think a fantastic way to do it is just pick with a little less chance of probability, but it's still above 90, which is fantastic. So that's one thing that I wanted to touch on. But let's say we do go back to the 292, 289. Let's look at the 292 put statistically. So if we hop in, if we look at the short put, here's the stats on it. So right now, like we were talking about, the current price is about 25 cents on it, or $25. This is the open interest, the IV, and then the chance of profit. So let's look at the deltas right now. So the delta, right, with a 0.07 means that every dollar that this was to drop, the contract would improve in value by roughly $7. So that's the one thing with spreads, right? Even if you have a $10 runway, if the stock maybe falls $2 right here, you're gonna be, that 25 is gonna turn into 39 just on your sell strike, right? So that's something where people ask me when they say, hey, my contract's losing value, why is that? Essentially what's happening is the IVs are pumping because people are starting to buy those. As DIA falls, maybe it falls from 301 to 299, someone will just come down and pick up a cheap put because they can, because that's how some people roll. But we also have to look at the Theta Decay. Now this is where Theta's on our side, right? Every day that goes by, this contract's gonna lose 7 cents. So with it sitting at 25, even if we traded sideways the rest of the week, every day you're getting chunked $7 or 7 cents out of that specific contract. And our whole goal is to get them as close to zero by expiration, right? We want these to become worthless because that's how we receive our credit. And if you're still confused by that, there's tons of other great places. You can also watch the video that Maz and I did to learn more about it. Let's go to another fund that I really love. So we'll look at IWM. This is another one that I love to trade on. Another index fund, right? The major indexes. Now it is a little extended in my opinion over the last 3 months. So if we look at that, look at the 5-year chart. Look at how straight up that is. So I haven't played this fund in a couple of weeks. I was playing it till the end of November. I still think it's overextended. In my opinion, it is holding a lot of great levels though. But let's say we do want to trade IWM some week. We go in, let's say we want a, let's get riskier on this one. 192. Let's sell the 192 put, which is still an 84% chance. Personally, I like 90. 88 to 92 is a fantastic spot to be in. So what I would do is actually personally sell the 187 or the 188 put. But let's say you did want to sell the 192 put this week, and then you went to buy, let's say, the 187. So you're putting up right here $500 in collateral to make $40, which is 8%, which is fantastic. 8% on your money. Now, personally, this wouldn't be where I'm going in with 10,000 in collateral, because to do that I would need 20 contracts. I'd make 800 bucks, right? Because there's the $5 spread of 192 to 187, which gives you your 500. You times it by your 40 credit, that looks like you'd be receiving $800 at the end of this week if IWM stayed above 192. Now currently, with how extended that chart is, this is not a position I would take right now. I do like trading IWM though, but if I had 20 contracts at a limit price of 40 cents or $40, I'd put up 10 grand in collateral to make 800, which is 8% in a week. This is what you would average holding IWM over the year. If you were to invest $10,000 a year ago, right, they're up 20%, you would make 8% in a week on them. But let's say even back, let's go to a month back, right? If a month ago we were looking at this trade and you invested 10 grand a year ago, you would be sitting at the same spot of 8% up as if we just played this credit spread for a week. Of course, you're taking on a lot more risk than just buying and holding an index fund over time. But if the probabilities are still in your favor, very well, you could take that trade at an 84.5% chance of probability. So even looking at that, right, you put 10 grand in a year ago. If we go back to a month where you make that 8%, let's say you do that 2 weeks in a row, you're basically coming up to what you would have gotten if you would have held it for a whole year. So I think that's a really cool chance, right? And of course you can still lose money buying shares, and you can also lose money, and when you're doing credit spreads, you have the ability of losing your collateral, right? So that's one thing we have to take into consideration there. So that's gonna be it for me today, guys. I really hope I showed you guys how to execute credit spreads like in a more in-depth way, and I showed you the ETFs that I like to do it on, and those are just a couple. I also like SPY and I like QQQ as well. So those are just fantastic ones to trade credit spreads on. That's the other thing too, there's a lot of opportunities, and you can also do it on single stocks. I've only done it a few times on single stocks, and I still like the ETF way better just because it's less volatility, right, over the whole broad market. So just really cool to see. But if this video helped you guys out, please leave a like on it, and also don't forget to follow me on Instagram and TikTok, as those are linked below as well, and I just post there as well. But YouTube's still my main thing, and I've been thinking about starting a second channel where I review movies and music, but it's coming down the road if I end up doing that. So I just want to say thank you guys for all the support, and I'm just super grateful and thankful. And I know 2021 is going to be even better than this year. And 2020 was a tough year, so there's a lot of things to look forward to in life in general and in everything. So just keep being humble, keep spending time with the family, keep spending time with the things that matter, and do what matters in your life. Those are just the important things. So hope you guys have a fantastic rest of your day and weekend, and I will see you guys in the Discord on Monday.